Six of the biggest names on Wall Street just agreed to help raise $500 billion for one company's chips. Good morning, it's Tuesday, August 11th. I'm Nick Vertucci with Eleanor Whitfield and Marcus Brooks, and today's a bridge day. Yesterday's Red session and a Red Sea oil scare behind us. Tomorrow's inflation print dead ahead. We'll recap what actually happened Monday, get into an Nvidia financing story that might be bigger than any single earnings report this year, and set up a loaded Tuesday night of results before CPI even lands. First, the scoreboard.
Which isn't going to be kind to me today.
Let's see. Marcus's call is actually still out there. Unscored. His was about CoreWeave's guidance language tonight, and CoreWeave doesn't report until after the close, so that one's pending. Not lost, not won. We'll grade it tomorrow. Eleanor, yours is done, and it's not the result you wanted.
No. I said if crude closed Monday above $80 a barrel, that's confirmation the Hormuz de-escalation trade was actually unwinding. It closed at 78.18. Didn't clear 80.
So that's a loss.
That's a loss. I'll own it. Oil touched above 80 intraday, then faded into the close. Which, if anything, argues for Marcus's red yesterday. Not mine.
I won't gloat about a call I didn't even make.
Generous of you.
Records, then. Eleanor drops to 12-9, and that's a second straight loss, streaks at -2. Marcus holds at 11-9, still riding his 6-game streak, call still in flight. Sarah's 0-1, Dave's 0-2, both still waiting on their next shot in that chair. Onto the tape. Monday actually told two different stories depending on where you looked.
It did. Headline-wise, Monday was a quiet red day. S&P off about 0.1% to around 7,750, Dow down a similar tenth to just under 54,000, NASDAQ the laggard, down about 0.3 as megacap tech gave back some of last week's gains. Not scary numbers on their own.
But
the VIX fell on a red day, down about 1.7% to just under 15. That's the tell. When the index drops and fear actually eases, that's usually not a broad flight from risk. It's money rotating between sectors, not leaving the market.
Rotating into energy, hard. The sector ran about 4.5%, easily the best group on the board. While real estate, utilities, and staples, the stuff that's supposed to hold up when yields ease, actually lagged. Odd grouping to see underperform on a day, yields were falling.
what flipped energy on?
The Houthis. A drone attack hit an Aramco refinery in Jazan on Saudi Arabia's Red Sea coast over the weekend. The Saudi Energy Ministry confirmed a fire. No casualties, but it's part of a run of strikes on Saudi oil infrastructure going back into July. Monday was the first full session to price it.
And crude still didn't get anywhere close to where it went after the worst of those July strikes. Brent topped $100 a barrel back then. Monday's move took WTI up toward 80. Then it faded to 78.18 by the close. That's a market pricing, a real but contained risk, not a repeat of the shock that hit the tape in July.
Contained so far. I'd be careful leaning on contained when the pattern is repeated, strikes on the same type of facility.
Now, here's the part of Monday I actually find more interesting than the headline number: small caps.
This is the one we're sitting with. At midday, the Russell was up over 1%, the best relative day for small caps in weeks. By the close, it had round-tripped completely, finished down 0.6%, the worst major index of the day.
That's a real reversal, not noise. Over 1.5 points of swing in a few hours. And it wasn't isolated. Coherent gave back over 10% on import ban chatter. Intel fell almost 4% on a share sale, and UWM Holdings, unrelated story, just got crushed, down nearly 35%, the single worst mover on the whole tape.
Meanwhile, 3 million and Exxon were up 3+% apiece. MP Materials up 7.5%. So underneath the boring flat headline, you had money actively leaving momentum names and small caps in the afternoon and piling into energy and a handful of idiosyncratic winners. That's not a picture of nothing happened. That's a market repricing risk appetite in real time. The index just didn't show it.
So, Monday in one line?
Calm on the surface, a real unwind underneath.
I'd still call it rotation, not unwind. Money moved, it didn't leave. Different word, same facts.
Let's talk about why the index barely moved at all Monday. Because there's a mechanical reason underneath even the calm read, and it's got an expiration date.
This is the gamma story. And it's worth translating because it sounds like insider jargon and it's actually pretty simple. Options desks estimate dealers were sitting on something like $50 billion of positive gamma exposure on the S&P Monday. When dealers are positioned that way, their hedging means they sell into rallies and buy into dips, mechanically, not out of any view on the market.
So they're the ones penning the index.
Functionally, yes. It compresses realized volatility. It's a big part of why a market 3 sessions off a record high felt almost boring Monday.
And there's a split inside the options positioning itself that I think is the more interesting tell. Equity put-call ratios are running call-heavy, people chasing single names with upside bets. Index put-call is running the other way, put-heavy, that's hedging. Institutional money buying protection on the broad market, even while retail keeps chasing calls in individual stocks.
Translate that in one sentence.
Traders believe in the rally enough to keep buying calls in stocks they like. But they don't trust the calendar enough to go without insurance on the index as a whole.
And that insurance has an expiration date, tomorrow, 8:30 Eastern. Positive gamma dampens moves until a big enough surprise forces dealers to re-hedge the other way. A hot CPI print is exactly the kind of shock that flips a market from boring to violent in the same session.
How much of tomorrow's move gets amplified by that positioning, on top of whatever the number itself says?
Hard to size exactly, but same-day options are now majority of S&P volume on a lot of sessions. That wasn't true a couple years ago. Positioning can build and unwind within a single day now, not over a week. Don't assume Monday's calm tells you anything about how Wednesday afternoon trades.
Which is the whole point. Today's quiet is not a forecast.
Speaking of things that didn't stay quiet, 4 earnings reports hit after Monday's close, and every one of them got sold regardless of what the actual numbers said.
It's a clean pattern, and it's the one we've been tracking all summer. Hims and Hers put up revenue up 38%, way ahead of estimates, raised full-year guidance, and swung to a net loss. Margins compressed hard, and the stock fell as much as 9% after hours. Revenue beat, guidance raise, sold anyway.
Rocket Lab's the more interesting case to me. Record quarterly revenue, up 62%. A backlog that's now over $2 billion and growing triple digits year over year, and the stock's down mid-single digits after hours. Then pre-market this morning, it's down closer to 9%. That's not a Monday overreaction fading. That's the market pressing the sell button harder, with a full night to think about it.
Why? The backlog number's genuinely good.
Because the loss widened more than expected. And right now, this market's decided burn rate matters more than backlog. I think that's a mistake for a name like Rocket Lab specifically. A $2 billion backlog with Neutron's first flight still on track is a real asset, not a promise. But I don't get a vote in how the tape trades it this week.
AST SpaceMobile's the cleanest example of the pattern. Honestly, revenue missed, the loss nearly tripled from a year ago, and the offset was backlog and government contract wins. Market didn't care. And Archer Aviation actually beat on both revenue and the EBITDA guide, and it's getting lumped in with the rest regardless.
So it's not really about any one company's numbers.
It's a regime. Pre-profit growth stories are getting priced on cash burn first, everything else second. And that includes the good news, not just the bad.
I'd add one qualifier. This is happening while yields aren't falling, and oil's climbing. Burn rate stocks are the most rate-sensitive part of the market. Part of what's punishing them isn't just their own numbers. It's the macro backdrop sitting on top of every growth name right now.
Which loops right back to tomorrow's CPI mattering, to basically everything we've talked about so far.
Everything.
Real quick, human moment. I've now said burn rate so many times this earnings season, I said it to my barista this morning by accident.
What did she say?
She said same, and charged me for the oat milk anyway.
That tracks. Nothing's getting a pass on optics right now, not even your coffee order.
Fair. Back to the tape. Varex Imaging, because this is the best story of the day, and it's not really about earnings at all. Varex jumped 48% Monday, single biggest mover in the entire market. Eleanor, what happened?
Teledyne agreed to buy them for $18.90 a share, all cash, about $1.1 billion, a 52% premium to Friday's close. Varex makes the X-ray tubes and detectors that go inside CT scanners.
I'm not going to make the obvious joke about seeing right through this deal.
You just did.
I did. Moving on before Nick cuts me off.
I was going to. What's actually interesting here is the price got paid on a company whose own numbers were getting worse, not better.
Right. Margins compressing, EPS falling, an actual GAAP loss on the books this quarter. And Teledyne still paid a premium above where analysts had it pegged even before the bid. This isn't a value price on a struggling company. It's a scarcity price on a technology position. Photon counting detectors that sit inside basically every next-generation scanner, regardless of who builds the box around it.
Which is the read-through I'd watch. GE Healthcare, Siemens Healthineers, Canon, anyone sourcing detectors from a third party just lost an independent option. And that's a reason for the whole group to think about vertical integration. Teledyne's own stock barely moved on the news, which tells you the market thinks this is a sensible bolt-on, not a stretch.
Anything that kills a deal.
Shareholder vote and regulatory review, standard stuff, close targeted for early 2027. So there's months where the ARB spread can move on any hint of a rival bid or antitrust friction. But the setup here, full premium paid for cooling fundamentals because the technology position is scarce, that's worth watching for more deals like it. It's a pattern, not a one-off.
Now, the story I open with, because I think this is the biggest structural news of the week, bigger than any single earnings report.
Nvidia's putting together financing platforms with Apollo, BlackRock, Blackstone, Brookfield, Goldman Sachs, and KKR, 6 of the largest capital allocators on the planet, to mobilize more than $500 billion of third-party capital for AI infrastructure. Jinsen Huang told CNBC he only approached those 6 firms and none of them turned him down.
What's the money actually for?
Data centers, power systems, the chips themselves. Financing structured so hyperscalers and AI labs can build faster than their own balance sheets would otherwise allow, using compute capacity itself as collateral. This is Nvidia essentially institutionalizing the AI build-out, bringing in permanent, structural capital instead of everyone financing it quarter to quarter off their own cash flow.
Eleanor, you're not smiling.
I'm not, because compute as collateral is a phrase that should make anyone who remembers 2008 sit up a little. You're financing depreciating hardware with debt structured through special purpose entities, at scale, across the same handful of counterparties who'd all be exposed to the same underlying asset if the demand assumptions underneath it don't hold. That's not diversifying risk. That's concentrating it in a new wrapper.
I think that's the wrong read of what this actually is. This isn't vendor financing propping up a customer that can't pay. Nvidia's not lending its own balance sheet here. It's Apollo and Blackstone and Goldman, real institutional capital, doing real underwriting at rates they think are attractive enough to commit $500 billion to. That's the market saying the demand case is credible enough to bet on for years, not quarters.
Underwriting compute the way you'd underwrite an office building assumes compute holds its value the way real estate does. Chips age out. A financing structure built to last a decade against an asset that's obsolete in 3 or 4 years is exactly the kind of mismatch that looks fine right up until it doesn't.
Every infrastructure financing deal ever done has had to solve for an asset that ages: power plants, fiber networks, cell towers. That's not a new problem. It's a pricing problem, and pricing it is literally what these 6 firms do for a living.
So where do you two actually split? Because I don't think either of you thinks this is nothing.
We split on whether attractive rates means the capital's confident or means Nvidia had to sweeten the terms enough to get 6 firms to concentrate this much exposure in one theme. I read the second.
And I read the first. Huang said nobody turned him down on the first ask. That's not 6 firms straining to get comfortable. That's 6 firms competing to get in.
I'm not going to resolve that one for you because it isn't resolvable today. The actual test is in the paperwork. When the first special purpose bonds price in the coming months, watch the terms, recourse or non-recourse. What happens to the lender if a data center's demand assumptions come up short? Real collateral protection, Marcus, is closer to right. Thin protection with a good story wrapped around it. Eleanor's closer to right.
That I'll agree to as the actual tiebreak.
Same.
And it's not just Nvidia catching a bid off this today. Riot Platforms is up something like 20% in pre-market trading on a $9 billion compute deal with Anthropic. Different structure, same theme. AI compute demand getting monetized in bigger and stranger ways than a straight GPU sale.
Which is exactly the kind of number that makes me want to see the financing terms before I get excited about the theme.
Let's get to what's actually on deck today and tonight, because it's a loaded Tuesday even before CPI tomorrow.
Tonight after the close, CoreWeave and Super Micro both report the test we flagged yesterday. Street's modeling CoreWeave revenue around $2.5 billion, more than doubling year over year, still a loss. Somewhere near $1.20 to $1.40 a share. What everyone's actually watching is the backlog, near $100 billion, and whether management's language around it is confident or hedged.
Analysts are already split going in. Piper Sandler's got an overweight and called it their top AI infrastructure pick. Barclays trimmed their target and flagged valuation and execution risk on an equal weight. Supermicro is expected to show revenue roughly doubling, too, with a margin guide that's actually improved a lot from where it stood back in the spring.
And futures this morning?
Mixed, which is about right for a market that's out of catalysts until 8:30 tomorrow. Retail sentiment's gone neutral on the S&P, and actually pretty bearish on the Nasdaq specifically, which tells you some of Monday's tech softness carried into how people are positioned this morning.
Give me the calendar for the rest of the week in 30 seconds.
CPI tomorrow, 8:30 Eastern Nuba consensus, is headline year over year around 3.4%, a touch cooler than June's 30.5%. Core month over month, forecasters cluster around 0.1 to 0.2%. Prediction markets have less than a 55% chance it prints above 3.3 on a year over year basis, so the market's leaning toward a benign number, not a hot one.
Thursday's PPI, Friday's retail sales, same as we said Monday. If CPI is soft and stays soft through producer prices, the cut case gets easier. If retail sales holds up too, this whole week reads as a soft landing, not a warning sign.
So, today's actually the calm before the real test, not the test itself.
Correctly put.
Let's get to calls. For tomorrow's session specifically, since that's when both CPI and tonight's earnings actually land at the price. Eleanor, you first, and I know you want to make up ground.
I do. Mine's on CP. If core comes in at 0.2% or hotter tomorrow, I think the small cap outperformance we saw at Monday's midday reverses hard. Same day. The rest will giving back Monday's whole round trip and then some, because that group's the most exposed to any slip in the rate cut timeline.
Marcus.
Mine's on tonight's earnings. If CoreWeave doesn't hedge the guide and Supermicro's margin number holds anywhere near that 15 to 17 range they flagged, I think the AI infrastructure trade, Nvidia included, off the back of the financing news, closes Wednesday higher, regardless of what CPI says. Good demand data beats when inflation print for that specific group, in my view.
2 calls, 2 different tapes. Eleanor's betting the macro number moves the whole small cap trade. Marcus is betting sector-specific earnings news overrides it for AI infrastructure names. We'll know by tomorrow night. Quick recap of where we are. Monday's calm was a rotation, not a retreat. Energy up on a real, if contained, Red Sea escalation. Small cap surging at midday and round-tripping into a loss by the close. Dealers are pinning the tape into tomorrow's CPI, and that calm has an expiration date. Growth earnings keep getting sold on burn rate, regardless of the top line. Ask Rocket Lab down again this morning, despite a record backlog. Nvidia just brought 6 of the largest pools of capital on Wall Street into the AI build-out, and whether that's smart institutional underwriting or concentrated risk in a new wrapper is genuinely unresolved. And tonight, before CPI even opens tomorrow, CoreWeave and Super Micro get to make their own case. If the show's useful to you, follow Nova Ventures Daily wherever you get your podcasts, and you can find our written notes at novaventures.us. That's your Tuesday morning brief. Have a great one, and we'll see you tomorrow, right after the number drops.